Welcome to Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. This week, we dive into the messes that banks make, the politicians who bail them out, and the regulators convinced that they know what's best for our own good. In the second half of our show, we'll speak with Professor Todd Zywicki from George Mason University, co-author of Consumer Credit and the American Economy. Up first, we're pleased to have former Federal Home Loan Bank President Alex Pollock, now at the American Enterprise Institute, an elder statesman and living historian whose book, Boom and Bust, Financial Cycles and Human Prosperity, boils decades of folly down to 90 pages. Alex, welcome to the show.
Thank you. Great to be with you.
Alex, you wrote a recent column in the Wall Street Journal that caught my eye titled, Our Financial Crisis Amnesia. What's your thesis?
The thesis is how easy it is for us as human beings to forget the financial crisis that was even fairly recent, let alone all the financial crises there have been throughout financial history. And in trying to think about the way financial markets work, we have to factor in this forgetting factor. I quote in the article a wonderful line of Paul Volcker's a few years ago, which was, about every 10 years we have the greatest crisis in 50 years. And we're always surprised.
It comes around. It's kind of like water shortages, you know. Let's start with the basics and then unpack that as we go. Murray Rothbard and others considered fractional reserve banking to be a fundamental fraud. Remind us why they felt this way.
Rothbard and others look back to the very history of banking, which started off when money was gold, coins, silver coins too, but let's just stick with gold. And to keep your gold coins safe, you brought it into the goldsmith who had safes, and you stored them, and you got a receipt for your coins.
And anytime you wanted, you could get your gold.
And anytime you wanted, you got a receipt for 100 ounces, and when you wanted, you could come back and get your 100 ounces. Then the goldsmiths, and we call these in financial history the goldsmith bankers, discovered the truth that not everybody was likely to come in at the same time. So they could make some money on the side by, say, keeping 50 of the coins and lending 50 out on the probability that not more than 50 ounces would be demanded at any one time, and then maybe you could lend out 80 and make interest on that.
And isn't that a fraud?
Well, that's what Rothbard said, or other people say, well, it's just the nature of banking. So if you believe that it's just the nature of banking, that you have lent out more than you have on hand, and it is the case that in almost all times, everybody doesn't come to withdraw their money at the same time, and things go on fine, and you make money. But the fact is, every once in a while, everybody, or at least a great number of people, do come in and want their money, and then you have a panic.
Yep. And isn't it proper for a customer then to say to the banker, hey, what percent of the money that you're saving for us do you lend out, and what do you keep in your vault? Isn't that the right kind of question to ask?
Yes, I mean, it's very true, and the honest banker would tell you, well, I've got, of course, nobody has gold coins anymore since the United States government confiscated everybody's gold in the 1930s and took away the monetary role of gold. By the way, it was illegal for an American citizen to own gold until 1974.
People forget that.
Another thing people have forgotten that. That's 4 decades of actually an amazingly despotic act by our government. But anyway, so it isn't that the bank has gold coins anymore, but they do have highly liquid assets, like deposits at the Federal Reserve Bank, or high quality short-term investments that would be a liquidity reserve. And that reserve, if the banker were honest with you, is not more than maybe 10% or so of the deposits. And the rest is lent out in various kinds of loans.
Now, you say that as if bankers are not normally honest.
No, they may be confused about what's really going on, even when they're doing it. But I think bankers are honest, and if they were honestly telling you, the customer, that's what they would say.
So history is replete with panics. You've got many of those stories in your book, Boom and Bust, which we'll talk about later. And the government almost always gets involved if voters are losing their money. and have created something called federal deposit insurance. Doesn't this create a tremendous moral hazard by relieving depositors of the responsibility to carefully consider the solvency of the banks that they're doing business with?
Yes, no question. Whenever you guarantee, which so-called deposit insurance is actually just a guarantee of the government, and who is being guaranteed is the person who is lending money to the bank. We call that a deposit, but it's really just a loan to the bank that you're making. And of course, if you think you're guaranteed by the government, well, what do you care about the bank? Because if the bank goes broke, you still get your money. And one of the ways we see the truth of that statement is in the brokered deposit business.
And what's that?
Brokers, and all of them, like say Merrill Lynch or any retail broker, will gather up certificates of deposit which are guaranteed by the government and just sell them to its clients up to the limit of the government guarantee, which is now $250,000. And people buy them, and they don't even know who the bank is, but they don't care.
They don't care.
And that's rational, because what they're really buying is the government guarantee. So the bank it is possible for the bank to be acting quite imprudently. Whereas if you were lending them money and you really saw what they were doing and understood it, you might say, well, I don't think I'll lend you this money. I think I'll put my money
somewhere else.
A different, more conservative place. But if you're guaranteed by the government, you don't care. And that is so-called moral hazard. It's a fundamental factor and fact in this behavior. Now, something else that happens is when the government guarantees the deposits, then it makes it possible for the banks not only, in some cases, to do imprudent things, but still be able to borrow money from you because you don't care. But it also allows all of the banks to run with much less capital for the same reason. So if we look back in history in how much of their own equity or capital a bank had to have compared to the size of the bank in the days before government deposit insurance or deposit guarantees, you find out, surprise, surprise, the banks had a lot more capital.
When times get tough and too many depositors want their money back, this capital is a cushion.
Yes, well, we say a cushion is a metaphor. What it really means is that's the banker's own money that's at risk. So first you have to pay back the money you owe, and depending on how much of the banker's own money is in the bank, you can pay back first the depositors, and then the losses fall on the banker's own money. But the less and less of the banker's own money is in the bank, the more and more likely it becomes the losses will fall on the depositors. So in days without the government guarantee, the market, the people, force the banks to have a lot more capital in order for the depositors to be able to trust the bank. Well, once the government has guaranteed the depositor, then the banks are able to run with less and less capital, which has been the trend over the last 7 decades, let's say.
Well, why can't politicians let banks fail the way other businesses fail?
The fundamental political decision, which has been made in this country and now in almost all countries, is that depositors aren't supposed to ever lose any money, not even a penny. So this is what I call the paradox of investing, and if you'll bear with me a little bit. So some ordinary person, say you or me, buys a share of stock for $100 a share, and it goes down to 50, and I've lost 50% of my investment. What do we say? We say that's too bad. That's the way it is in the stock market. Let's say I buy a junk bond, and I buy it for 100, and it goes down to 50. And let's say the issuer of the junk bond goes broke, and I get 50 cents on the dollar. What do we say? We say, well, that's too bad, but that's the way it is when you're investing. But if I put my money in the bank, and somebody thinks I'm going to get 99 cents on the dollar if the bank fails, we call that a financial crisis.
We've had quite a few. Remind us of the savings and loan. People forgot that one. Remind us of the savings and loan fiasco that came our way, 30 years ago?
Yes, one of the things that I say in this article, you're so kind as to mention, is that we had a searing decade of the 1980s of multiple financial crises, of which the savings and loan collapse was one. Now, something that's really interesting about the savings and loan collapse is the whole industry, on average, became insolvent.
Mm-hmm.
And the reason it did was because interest rates, and we've forgotten this one too, but interest rates went up to 15, 16% in the late 1970s and early 1980s.
Mm-hmm. Jimmy Carter inflation.
Well, it's really the Arthur Burns inflation.
Okay, fair enough.
It's the Fed that did it, don't
Fair enough.
Then Volcker came in and said, well, the Fed is fighting inflation, but the Fed was fighting the inflation that the Fed created.
Mm-hmm.
Usually that's something else we forget. They caused the problem in the first place.
Mm-hmm.
Anyway, the savings and loans had made long-term mortgage loans at, say, 5%, and they were now paying 13, 14% on their deposits. You can't do that very long before you're broke. And they were broke. And in fact, if you mark to market, as we say, or valued all the savings and loans around 1980 at market values, the whole industry had a negative net worth of around $100 billion, which was equal at the time to the positive net worth of the entire banking industry.
Wow.
So I had a little joke in those days. I used to say, well, we could get all the banks to acquire all the S&Ls, and then we'd have a financial system with zero capital.
And how did that all play out? What did that cost the taxpayers?
Well, in the end, it cost the taxpayers $150 billion. In inflation-adjusted numbers, a bigger number than what had to be put into Fannie and Freddie when they went broke.
Isn't
but anyway, hundreds of savings and loans were insolvent and failed. But something really interesting happened in addition. There was a government deposit insurance or deposit guarantee fund for the savings and loans. It was called FSLIC. People said FSLIC, Federal Savings and Loan Insurance Corporation.
And they've been paying into that.
They've been paying into it for decades, since the 1930s. The government deposit insurance company itself went broke.
Mm-hmm.
So the savings and loans, obviously not all of them, but on average, they went broke. And their government deposit guarantor was completely broke and insolvent. So it had to be closed down as well. And then, instead of saying, you said before, could the politicians say, well, you're a depositor in a broke, in this case S&L, you've lost money. Instead, they said, no, we're going to make all the depositors good. And that was about $150 billion of taxpayer money. Now, here's something else that's interesting. Where did they get the money to pay off? Where did the government?
Where did it come from?
All the money that had been paid into the deposit insurance fund was gone because it was broke. So where did the money come from to pay off the S&L debts? The answer is the government borrowed it.
Lovely.
They set up a new shell corporation, which, by the way, was kept off the government books through some clever structuring. And they issued 30 and 40-year bonds to raise the money to pay off the S&L collapse. Now, this was some of these bonds were issued in 1990. So 1990, 40-year bonds. These bonds run until the year 2030. So today, 2014, we've still got 16 years to pay
that last crisis.
The bailout of the S&Ls in 1989, 1990.
So, Alex, what laws were passed to make sure banks would never fail again?
Yes, well, in the end of the 1980s, of course, they said, look, this is terrible. And by the way, it is really important, if I can just stick this in. It wasn't only S&Ls that failed. Hundreds of S&Ls failed, but way more than 1,000 commercial banks also failed in the 1980s. And nobody remembers this at all. So it was a number like 700 or 800 S&Ls, but far more than 1,000 commercial banks also failed during the 1980s. And in total, it was over 2,200 depository institutions. So this was a really severe crisis.
So Congress sprung into action, and they passed laws to fix it, right?
Precisely. They passed to fix it forever.
Forever.
This is really important. We're fixing this forever. And as the then Secretary of the Treasury said, we're going to make sure this never again happens. By the way, a recurring event after financial crises is that high-ranking officials of the government say, we're going to make sure this never happens again.
Yeah, it's like the war to end all wars.
That's the war to end all war. These are the new government committees, regulations, rules, and we're going to make sure this never happens again. So that's what they said then as well after the 80s crisis. And so first there was the Financial Institutions Reform, Recovery, and Enforcement Act of 1989. It's called FIREA. And then there was the FDIC Improvement Act of 1991. A good friend of mine is the intellectual father of that act, and he said this will guarantee that we'll never have these banking problems again because we've done all these improvements. They knew that deposit insurance was an important part of the problem, and so they were trying to improve deposit insurance. Obviously, it didn't work. And then maybe you think of the funniest one of all was the GSE. Now, GSE stands for Government-Sponsored Enterprise, which means Fannie Mae and Freddie Mac.
They were going to fix it forever.
They're fixing them forever, too. They called it GSE, Financial Safety and Soundness Act of 1992. Well, we know what happened to Fannie and Freddie. They went utterly broke. So that one is a pretty funny title in retrospect.
Well, you've called the Fannie and Freddie model a profound mistake. How do we dig ourselves out of that trap? Because they're still with us.
They are still with us, and I'm afraid that the great opportunity which was there to really get rid of Fannie and Freddie as government-sponsored enterprises, which is the mistake, has passed. I think the political opportunity has been missed. So what I think we can do now is to, let's say, defang Fannie and Freddie. And my current proposal, which actually I think is the best possibility politically right now, instead of what we might have been able to do in other circumstances, which would have been really to privatize them.
Too late.
Get rid of them altogether and replace them with a real private market. It's too late. It's not going to happen.
It's too nice a honeypot. It's too nice a honeypot for the politicians.
Oh, no. Absolutely. Fannie and Freddie, among other things, were popular with politicians because it was a way to give money to the politicians' friends, but they didn't have to appropriate any money. What I'd like to do is treat Fannie and Freddie in every way just like any big bank. Same capital requirements, no special privileges. You have to pay the government for the guarantee you get from the government. It'd be better to get rid of the guarantee, but can't do it, so we at least make them pay. We take away all their special tax exemptions and just make them so all they are is one more competitor among maybe 8 or 10 big banks. And then we could have a genuinely competitive secondary mortgage market. And it wouldn't be the ideal, but it would be a whole lot better than what we've got now. And I think it's the best we can get to if we can.
Yeah. What do you make of the revolving door between Wall Street and Washington? Has Goldman Sachs effectively merged with the Treasury Department?
Well, there was an old joke, a thing that went around on the Internet. I think it was when Henry Paulson, formerly of Goldman Sachs, was Secretary of the Treasury. By the way, his book is very interesting to read on the crisis. Henry Paulson's book, On the Brink, because it's almost like a diary of his life through the crisis. I recommend it. And one of the things you learn from reading that book is how the government and the Treasury was continually and greatly surprised all the time by what happens. It's a wonderful antidote to anybody who thinks the government knows what's going on to read that book.
But now we've got it all solved. The Dodd-Frank bill has... you don't even let me ask my question. The Dodd-Frank bill is going to make sure this never happens again.
Never again.
You've actually called it the Faith in Bureaucracy Act. Why?
Yes, because that's what it is. I mean, the Dodd-Frank Act is a couple thousand pages of giving power to bureaucrats outside of the democratic processes of the Congress to run things. And one of the greatest examples of that is the FSOC, or Financial Stability Oversight Committee, which is set up as a little empire on its own. We just had a conference here yesterday, in fact, at AEI, which I chaired, on the problems created by this. And the name of the conference was, "Can a committee create financial stability?" Which is supposed to be a self-answering rhetorical question.
And this is an omniscient...
What a silly idea. Oh, yeah, an omniscient, of course.
Omniscient committee. They can see everything coming, right?
We take a bunch of heads of bureaucratic agencies and we make them into a committee, and of course they can see what's going on and fix everything.
So when is the next disaster going to hit us?
The historical average of financial crises over the long run is Volcker's witticism had it, about once a decade or once every 10 years. So if we meet the historical average, that would be 2019. The most recent crisis ran in this country, because there was also a parallel European crisis which ran a little later, but in this country, 2007 to 2009. So 2009 plus 10 years would be 2019. That's 5 years from now, and that's plenty of time for more forgetting. As we've been discussing, human beings are very good at forgetting. I started in my own life the serious study of financial history when I was already in my 40s, and I suddenly realized here I'd been working in banking, but I knew nothing about the history of it, and I thought surely I could get myself smarter, and I found the financial history quite fascinating. And I am of the opinion that if decision makers of various kinds, that is to say, both in the private sector executives and managers and investors, and also politicians, and also central bankers and so on, that financial history could help them make much better decisions and have more wisdom if they knew any, which they don't.
You distilled your learnings in a short book called Boom and Bust. Tell us about that.
Boom and Bust, I wrote in the wake of the last crisis to try to put it in the perspective, just as I was talking about a financial history, and I talk about the theory of financial cycles, why they happen, the relationship of long-term growth in a free market or an enterprising economy, which, as we know, is the greatest miracle of modern times, is extended long-term growth, which makes ordinary people lead wonderfully comfortable and interesting lives. And the relationship of the underlying innovation and therefore uncertainty, which creates that growth, but also creates cycles. So we get the cycles along with the growth. And then we look through a lot of the history of cycles. I have some great stories, figure out that government regulation cannot prevent or control, and in fact, as in the case of Fannie and Freddie, as in the case of the savings and loans, contributes to creating the cycles and makes them worse. And then we will discuss a few ideas of what we might do, perhaps to moderate cycles going forward.
Well, Alex, it's been a fun walk through history with you. We'll definitely have you back on next time the banking system collapses.
Thank you very much. See you in 5 years.
Take care. That was Alex Pollock, author of Boom and Bust, Financial Cycles and Human Prosperity, here on Real Clear Radio Hour, brought to you by the Competitive Enterprise Institute. I'm your host, Bill Frezza. Ahead, Todd Zywicki clues us in on the relationship between consumer credit regulation, demonized payday lenders, and the rise and fall of infamous loan sharks like Fat Tony Salerno. Stay tuned.